Welcome to Bulls, Bears, and the Bell Afternoon Edition. On the surface, looking at the closing bells on Wednesday, August 27, 2025, it seemed like a day for celebration, the S&P 500 hitting a brand new all-time high. But if you, our astute listener, were paying close attention to the underlying currents, you'd feel that calm surface belied a palpable sense of tension. And really a remarkable narrowness of conviction in the market. It was one of those days where the headlines might have cheered, but, well, the smart money was kind of holding its breath.
Indeed. Beneath those, pretty modest headline gains, global investors were collectively holding their breath. They were waiting for arguably the single most anticipated event of the entire earnings season, the post-market quarterly results from the artificial intelligence bellwether, NVIDIA.
NVIDIA, right, looming large.
Exactly. So this day's trading truly represented a market at a critical crossroads. It felt caught powerfully between the, let's say, exhilarating forward-looking narrative of an AI-driven tech revolution and the more immediate, tangible realities of a complex macroeconomic picture. And layered on top of that, an increasingly volatile political landscape. Our mission today is to dive deep into all these interwoven layers, to move beyond just the superficial numbers and uncover what was really driving the market. And more importantly, what these intricate dynamics mean for you and your understanding of the financial world.
Okay, let's unpack this apparent paradox then. The headlines, like you said, were screaming new highs. The major U.S. stock indices all finished in positive territory, seemingly continuing their impressive upward momentum. The S&P 500 did indeed notch a new record, closing at 6,479.25. That was a gain of plus 13.31 points, or, plus 0.21%. Small gain for a record, maybe.
Pretty fractional, yeah.
Yeah, right. And not to be outdone, the Dow Jones Industrial Average advanced a solid plus 0.43% to 45,614.60. The Nasdaq Composite ticked up just plus 0.12% to 21,569.18. Even the small-cap Russell 2000, often seen as a barometer for broader market health, gained plus 0.56% to 2,371.80. But beneath those seemingly cheerful numbers, a closer look at the market's internal mechanics reveals a much more nuanced and, frankly, maybe a bit unsettling story.
Precisely. While those headline numbers certainly look good on paper, an examination of market internals reveals a picture, well, far removed from broad enthusiasm.
Okay.
Like you said, these gains were quite fractional, especially for what should be a celebratory new all-time high. It was tracking notably below recent 20-session averages.
Low volume.
Yeah. And this subdued activity, particularly right before such a pivotal event like NVIDIA's earnings report, suggests that a significant number of institutional investors were positioned firmly on the sidelines.
Just waiting.
Just waiting. They were unwilling to commit substantial new capital before clarity emerged from this highly anticipated release. It essentially put the broader market on kind of an acute pause. It's almost as if the entire institutional world was holding its collective breath, much like spectators watching a high-stakes poker game, right? Waiting for one player to show their hand before making any big moves.
Okay, so light volume, fractional gains. What about the breadth? Were lots of stocks participating, or was it just a few pulling things up?
That's a crucial point. What stands out here is that the market breadth, which measures the number of advancing stocks versus declining stocks while it was positive, it wasn't overwhelmingly strong. On the prior trading day, advancing issues had robustly outnumbered decliners, which signaled broader participation. But Wednesday's action was more balanced. It indicated a rather selective rather than a truly broad-based rally.
So not all boats rising.
Not at all. It was more like a few powerful currents pushing specific, very large vessels forward, while others remained sort of anchored. And the CBOE volatility index, the VIX, often called the fear gauge, it remained contained below 15. But importantly, this wasn't indicating widespread investor complacency or confidence.
Interesting.
It felt more like a unique state of market paralysis, that collective holding a breath, where participants weren't expressing outright bullishness or bearishness, but were just stuck in a waiting game for the perceived risk ahead to materialize or maybe dissipate.
Okay, so paralysis, not confidence. That makes sense, given the NVIDIA overhang.
Exactly. And placing this in a broader context, the S&P 500's new record high wasn't indicative of broad, unbridled confidence in the entire economic landscape. Instead, it represented a rather fragile and narrowly supported advance. It was heavily contingent on the continued high performance of the mega-cap technology space.
The big names.
The really big names. The market's valuation has become increasingly concentrated in just a handful of these dominant companies. and NVIDIA holds immense, almost singular influence over the index's immediate direction.
Right.
So the day's price action, then, it was less a definitive verdict on the overall state of the economy or corporate health,
Uh-huh.
and more a placeholder, a collective positioning and anticipation for the shockwaves, whether positive or negative, expected to emanate from NVIDIA's report after the closing bell. This concentration, at these elevated levels, it draws parallels to previous market cycles where narrow leadership eventually proved unsustainable.
Right. That never ends well, usually.
It rarely does. It felt like the market was bracing itself,
Yeah.
rather than truly celebrating a robust expansion.
So for our listeners, what are the actionable takeaways from this? I mean, given this concentrated advance, where a few mega caps essentially drag the entire index higher, is the market inadvertently revealing a structural weakness in broader economic growth, where maybe only a select few dominant players can truly thrive?
That's a key question.
For you, this isn't just about market direction, right? It's about understanding if the fundamental engine of growth is actually narrowing. That could signal a more challenging environment for diversification and stock selection going forward. It feels like we're walking on eggshells, even as the numbers climb to new records.
That's a very apt analogy, walking on eggshells.
So if you were wondering why the market seemed to be treading water, or perhaps dancing on those very eggshells you just mentioned, the answer was largely singular: NVIDIA. The entire investment world, I mean, from institutional giants managing trillions to individual day traders in their home offices, seemed to be orbiting around this one company's after-hours earnings report. It really felt like the gravitational center of the financial universe on Wednesday.
Indeed, the market's focus on Wednesday was overwhelmingly centered on NVIDIA's quarterly earnings report. It has truly evolved into the single most important barometer for the health and, frankly, the continued viability of the AI investment thesis. That thesis has powerfully propelled equities higher throughout 2025.
Yeah, it's been the story.
It has. And this begs the critical question: why this one company, above all others, carries such immense weight? Investors viewed this report not merely as a reflection of NVIDIA's individual performance, but as a crucial, almost definitive validation, or conversely, a refutation of the massive, multi-billion-dollar capital investment currently flowing into AI infrastructure globally.
The pick and shovel play for AI.
Exactly. The market perceives NVIDIA as the primary pick and shovel provider for this new digital gold rush. That makes their results a bellwether for the entire AI revolution, a proxy for the whole industry's trajectory.
Okay, so the stakes were incredibly high. What were the expectations like going into the report?
The remarkable aspect here is just how sky-high the expectations for the chipmaker were set. Options markets, for instance, were pricing in a truly significant post-earnings stock move. Some models were suggesting an implied swing of maybe 10–15% in either direction.
Wow, that's huge.
It is. It indicated widespread anticipation of extreme volatility. This wasn't a modest forecast. It was a prediction of a potential seismic shift. And leading into the report, analysts were overwhelmingly bullish. Numerous firms were raising price targets on NVIDIA shares, some reaching, frankly, unprecedented levels. They cited strong, undeniable demand signals for NVIDIA's cutting-edge graphics processing units, or GPUs, which are the fundamental building blocks for AI development and deployment. The general consensus among these experts was that the company would deliver record sales and profitability, even with some acknowledged impact from U.S. export curbs to China.
Right, the China restrictions were a known factor.
A known headwind, yes,
Yeah.
but apparently not enough to dampen the overall, almost euphoric optimism surrounding the company.
So connecting this back to the broader market trends, this intense focus, this almost singular focus on NVIDIA, it really underscores the market's profound dependency on the AI narrative to justify these elevated valuations, doesn't it? Not just for NVIDIA, but across tech and maybe even beyond.
Absolutely. Many growth stocks, particularly those linked even tangentially to AI, have seen their prices surge to levels that require not just strong but exponential future growth to rationalize. NVIDIA's results were truly a critical fulcrum upon which near-term market direction would pivot.
A fulcrum, yeah.
A strong beat could fuel another leg up for the entire technology sector and broader market indices. It would reinforce the AI narrative, maybe even attract a new wave of capital into AI-related ventures. A miss, on the other hand, well, that could trigger a significant repricing of risk, especially in those highly valued growth segments. It could potentially send ripples throughout the global equity markets and challenge the very foundation of the AI investment thesis.
So the stakes, as you said, truly couldn't be higher. It feels like the market has bet really heavily on a single, powerful technological wave, maybe embodied by this one company.
It certainly felt that way on Wednesday.
You've highlighted the market's near absolute dependency on this AI narrative, particularly NVIDIA's performance. But doesn't this singular focus make the entire AI thesis and indeed the broader market incredibly vulnerable? Are we creating a single point of failure for market sentiment here? Or is there a robust underlying infrastructure that can maybe weather a potential stumble from a bellwether like NVIDIA?
That is the multi-trillion-dollar question, isn't it?
Yeah,
There's definitely an argument that the underlying demand for AI compute is real and broad-based. But the market's perception and valuation are so heavily tied to NVIDIA's continued hypergrowth
right.
that any disappointment could certainly cause a disproportionate reaction. It highlights the difference between the long-term technological trend and the short-term market sentiment attached to it.
So for our listeners, this isn't just about a company making chips. It's really about the future of technology and how much conviction we as investors are willing to place on that future may be concentrated in one spot. The market's reliance on this one company for validation makes the entire system feel incredibly sensitive, almost like a house of
But a
cards.
delicate structure, certainly.
Okay. But while everyone was hyper-focused on corporate earnings, particularly NVIDIA's, a deeply unsettling political development unfurled in Washington. This introduced a whole different and arguably more systemic kind of risk to the equation, one that could have far-reaching implications beyond a single earnings report, potentially eroding, foundational trust.
That's right. The decision by President Donald Trump to dismiss Federal Reserve Governor Lisa Cook that reverberated through institutional circles. It raised profound questions about the long-term independence and credibility of the U.S. central bank.
And this wasn't exactly out of the blue, was it?
No, it didn't come out of nowhere. It followed a period of escalating public criticism by the president aimed directly at Fed Chair Jerome Powell over the path of interest rates. This signals a growing tension between, let's say, short-term political influence and the traditional autonomy of monetary policy. And history has shown that dynamic can be deeply disruptive to financial stability,
Yeah, undermining Fed independence is usually seen as a big negative.
a huge negative.
Hmm?
And a critical aspect to consider here is that while many traders largely looked past this news on Wednesday, their eyes were glued to NVIDIA.
Right, the immediate thing.
Exactly. But this development introduces the very real potential for a long-term political risk premium on U.S. assets. The global financial system, as we know it, is built on the bedrock assumption of the Federal Reserve's operational independence and credibility.
Mm-hmm.
This independence is crucial because it allows the Fed to make tough, often unpopular decisions about interest rates and money supply, free from short-term political pressures that could compromise its long-term goals of price stability and maximum employment. Actions that erode this perception of independence could lead international investors who are major holders of U.S. debt and equities to demand higher returns to compensate for this added political uncertainty and perceived risk.
So basically, if you think the Fed might be told what to do for political reasons, you want to be paid more to hold U.S. bonds or stocks.
Precisely. If you're investing in a country where the central bank's decisions can be directly influenced or overturned by political figures, that's an additional layer of risk you need to price in. This could manifest as structurally higher Treasury yields over time as bondholders demand more for lending to the U.S. government, and potentially lower equity valuation multiples as investors become more cautious about the stability and predictability of the policy environment. Think of it like a contractor bidding on a project in an unstable region. That extra danger pay is essentially what investors might start demanding from U.S. assets.
That's a good analogy. And are we seeing any signs of this actually happening? Or is it just a theoretical risk right now?
Well, from a broader vantage point, we're already seeing tangible, albeit early, signs of this potential global shift in asset allocation strategy. For instance, the recent disclosure from the Swiss National Bank, a significant player, they have the third largest foreign exchange reserves in the world.
Right, SMV.
Yeah, that they've been actively diversifying its reserves away from the U.S. dollar and into euros. That serves as a powerful and concrete example.
Wow, okay.
This isn't just a theoretical concern for economists. It's a real-world action taken by a major central bank, signaling a cautious recalibration of global confidence. And this forces us to consider what happens to the global financial system if the bedrock of confidence in U.S. institutions, particularly the independence of its central bank,
There.
begins to crack.
Yeah.
The dollar's status as the world's primary reserve currency is intimately tied to this trust. Any sustained erosion of that trust could have profound and far-reaching implications for global finance, trade, and even the geopolitical balance of power. This is a slow burn risk, but one with potentially catastrophic implications down the road.
Okay, a slow burn risk. So if we're now potentially pricing in a political risk premium on U.S. assets for your investment strategy, what are the implications here? Are we talking about a temporary blip, or could this fundamentally alter the global pecking order of capital flows, maybe accelerating the shift we've already seen with the Swiss National Bank?
It's too early to say definitively if it's temporary or structural, but it's certainly a risk factor that wasn't as prominent before. The idea of a politicized Fed could introduce a whole new layer of uncertainty that impacts everything from your borrowing costs on a mortgage to the long-term returns on your investment portfolio.
Mm.
It's a significant, slow-moving undercurrent beneath the daily market movements, and it's definitely something for you, the listener, to keep a very close eye on, even when headlines are dominated by tech earnings or other immediate news.
Absolutely. Okay, so on one hand, we've dissected the market's almost singular obsession with AI through NVIDIA. On the other, this profound, slow-burning risk to our institutional bedrock with the Federal Reserve. Now, let's bring in the immediate pulse from Main Street. What kind of picture was the hard economic data painting for us on Wednesday amidst these swirling crosscurrents? Were we seeing clear skies or maybe storm clouds gathering for the average consumer?
Well, the stream of economic data provided a pretty complex backdrop for investors. Definitely a mixed picture of the U.S. economy, showing some divergence between, say, market sentiment and real-world consumer behavior. The most recent reading of the Conference Board's Consumer Confidence Index, which actually came out on Tuesday, showed a notable decline to 97.4 in August.
Okay, confidence down.
Yeah, and this is a significant indicator because it suggests that while the stock market might be hitting new highs, there's a growing sense of unease among ordinary consumers. Specifically, the Present Situation Index, which reflects current business and labor market conditions, that remained relatively strong. However, the Expectations Index, which gauges consumers' short-term outlook for income, business, and labor market conditions, that saw a more pronounced drop.
So worried about the future more than the present.
Exactly. It indicates rising worries about job security and future income began to overshadow what were previously more optimistic views on current business conditions. It tells us that what's happening on Wall Street might not fully align with the sentiment on Main Street.
Right.
And on top of that, consumers' inflation expectations also ticked higher. That's a development the Fed will undoubtedly monitor very closely, as it directly impacts their dual mandate for price stability and maximum employment.
Okay, so consumer confidence is shaky, especially about the future, and inflation worries are creeping up. How did the market react to this?
Well, what's particularly telling is that this weakening consumer outlook, combined with some recent softness observed in labor market data like a slight uptick in jobless claims, a moderation in wage growth, it seems to have solidified market expectations for a significant monetary policy pivot from the Federal Reserve towards cutting rates.
The Fed pivot narrative again.
Exactly. Following decidedly dovish commentary from Fed Chair Jerome Powell at the recent Jackson Hole Symposium, where he signaled a potential shift in policy, markets are now pricing in a greater than 87% probability of a 25 basis point interest rate cut at the Fed's September meeting. That's according to the CME FedWatch tool.
87%, that's pretty high conviction.
Very high conviction. It indicates that investors strongly anticipate a loosening of financial conditions, making borrowing cheaper for businesses and consumers, and theoretically boosting corporate earnings and valuation multiples. Historically, though, such strong anticipation of Fed cuts has often preceded periods of economic deceleration, not robust growth.
Right, the Fed usually cuts when things are slowing down.
Precisely.
So placing this in context, this anticipation of looser financial conditions, lower rates, easier credit, that's been a big tailwind for stocks, hasn't it?
Significant tailwind, yes. Lower interest rates generally make borrowing cheaper for companies, which can boost earnings. And they also make future earning streams more valuable in present-day calculations through a lower discount rate. This effect has allowed the stock market to continue its upward trajectory, even as some underlying economic indicators, like consumer confidence, begin to soften. It creates this delicate balance where the market is heavily relying on the Fed to provide support, almost like a safety net, to sustain its elevated valuations.
Okay.
This forces us to consider, how long can equities thrive on the expectation of central bank support if the underlying economic reality continues to diverge?
Right.
This dynamic presents both an opportunity for continued growth if the Fed acts as expected, but also a hidden risk if that reliance becomes too profound and the central bank's ability to support the market is constrained by, say, persistent inflation or other factors.
It sounds like the market is very much banking on the Fed to provide that crucial support, even as consumers start to pull back and express more caution. For your outlook on the economy, what's the actionable takeaway from this reliance? Is it a setup for continued growth, primarily driven by central bank intervention? Or are there hidden risks in this heavy reliance on central bank action, maybe masking deeper structural issues in the economy? It's a bit like watching someone walk a tightrope, with the safety net being the Fed, but how robust is that net if the walker gets too confident or if the wind picks up?
That tightrope analogy is quite fitting. The market seems confident the net is there and will hold. But any sign that the Fed might hesitate, perhaps due to inflation, or that the economic slowdown is sharper than anticipated, that could cause a significant wobble. For you, the listener, it means recognizing that the current market strength isn't solely based on strong fundamentals. It's heavily influenced by policy expectations. That adds another layer of complexity to risk management.
Okay, good point. So, with all these macro and political crosscurrents swirling and the market holding its breath for NVIDIA, where was capital actually flowing within the market on Wednesday? What were investors betting on, or perhaps what were they actively avoiding in such an uncertain yet record-setting environment? It's like checking the vehicle's individual gauges to see where the power is truly being applied.
Right. Capital flows on Wednesday showed a slight risk-on preference among investors, though it's important to reiterate that gains were generally muted across the board as everyone awaited clarity from NVIDIA. Crucially, based on recent full-day data from Tuesday and the intraday trends observed on Wednesday, cyclical sectors broadly outperformed their defensive counterparts.
Cyclicals over defensives,
Yes.
okay.
This suggests a subtle underlying optimism about future economic activity, even amidst the immediate uncertainty. It seems investors were positioning themselves for a potential economic pickup, perhaps spurred by that anticipated Fed easing.
Let's break down the sector performance then. Where was the money really moving?
Okay. 7 of the 11 S&P 500 sectors finished Tuesday's session in positive territory, and this trend largely continued into Wednesday. We saw sectors like industrials, which gained 1.0% on August 26th, and consumer discretionary, which saw a 0.5% gain on August 26th, finding notable support.
Right, those are sensitive to the economy.
Exactly. These are sectors that typically perform better when the economy is expanding, as they benefit from increased business investment and consumer spending. Their gains were likely fueled by the belief that a potential Fed rate cut could bolster economic activity, making consumers and businesses more willing to spend and invest. Information technology also posted modest gains, advancing 0.5% on August 26th. And financials saw some positive momentum during Wednesday's session itself, likely benefiting from the broader risk-on sentiment and anticipation of a more stable economic environment, which could improve lending activity and profitability.
Okay. And what about the defensive side?
Conversely, more defensive areas of the market, such as consumer staples, which actually led declines on August 25th, saw limited interest. This reflects a market that is not yet fully positioned for a significant downturn or recession. It indicates that investors are still leaning towards growth over safety, at least for now, prioritizing potential upside from an easing Fed.
Interesting. So still leaning risk on despite the nervousness. What about specific industries? Any standouts?
Yeah, if we dive into specific industry spotlights, we could see even more granular trends. Database software was the undisputed standout industry of the day,
Okay.
and that was unequivocally led by MongoDB's explosive post-earnings rally, which we'll talk more about soon. Its stellar results created a powerful positive halo effect, significantly boosting sentiment for enterprise software firms, particularly those that could articulate a strong AI and cloud-native narrative.
Ah, the AI connection again.
Absolutely. MongoDB, being a NoSQL database provider, is particularly well-positioned because its flexible architecture is highly adaptable for handling the unstructured, massive data sets generated by AI applications. It makes it a critical infrastructure play. This highlights how a single strong performer can lift an entire subsector by validating a key technological trend.
What else stood out?
Then we had a rare bright spot emerge in the often challenged department store retail industry.
Really? Department stores?
Yeah, surprisingly. Kohl's delivered better than expected profitability and raised its guidance, which provided a significant sentiment lift for the entire sector, or at least for Kohl's itself. Kohl's success here wasn't driven by soaring sales, but rather by disciplined operational management.
Okay.
They focused on strategic inventory reduction, rigorous cost-cutting initiatives, and improving gross margins by reducing promotional activity. It suggested that effective operational turnarounds can still succeed even in a difficult consumer spending environment. It proves that specific company strategies can sometimes buck broader industry trends and reward investors for focused execution.
Good for them. Any other industry highlights?
Well, lastly, the entire semiconductor complex traded in a state of kind of suspended animation.
Waiting for NVIDIA.
Exactly. While the Philadelphia SE Semiconductor Index has been a strong performer recently, reflecting the broader AI excitement, most individual chip stocks posted only minor moves on Wednesday. This pause clearly shows investors awaiting the final word from the industry's undisputed leader, NVIDIA, before committing further capital. It underscores the immense leverage NVIDIA has over the sentiment of its peers. Its gravitational pull is so strong that the rest of the industry essentially waits for its signal.
Yeah.
This dynamic highlights the deep interconnectedness and event risk concentration within this critical sector.
It really highlights how selective this market is, doesn't it? Even within sectors, you have very specific stories and catalysts driving performance rather than just broad tides lifting all boats. For the astute investor trying to make sense of it all, this landscape suggests you can't just buy the index and expect everything to go up. You really need to understand the individual narratives, the operational triumphs like Kohl's, and the specific technological tailwinds or headwinds for particular companies like MongoDB or the semis waiting on NVIDIA.
Precisely. It feels like this is truly a market-rewarding, detailed fundamental analysis and active management, or at least very careful selection.
Okay. While the broad indices might have shown those modest gains and capital flows hinted at broader preferences, the real fireworks and some significant fizzles were happening at the individual stock level. This is where the market truly reveals its micro-level drama, showcasing the stark contrast between broad sentiment and company-specific triumphs or tumbles. These are the stories that often contain the most compelling lessons for you, the listener.
Absolutely. The subdued action in the broad indices truly masked extreme volatility at the individual stock level. Company-specific news created massive price swings, offering critical insights into both the triumphs and challenges facing businesses right now. It's a testament to the idea that even in a highly narrative-driven market, individual corporate performance still matters immensely.
So let's get into those dramas. Let's start with the triumphs. You mentioned MongoDB and Kohl's.
Right. Let's look at the earnings triumphs. Starting with MongoDB, MDB, the database platform provider. Its shares absolutely skyrocketed, closing with a staggering gain of approximately 35%.
35%.
An incredible move.
Hmm.
The catalyst was an exceptional fiscal second quarter earnings report that far surpassed even the most optimistic analyst forecasts. The company posted adjusted earnings per share, EPS, of $1. That crushed the consensus estimate of around $1.66.
Big beat.
Huge beat. Revenue grew a robust 24% year over year to $591.4 million. And critically, MongoDB also raised its full-year revenue and profit guidance significantly, signaling strong confidence in its business momentum and future prospects. Management specifically highlighted accelerating growth in its Atlas Cloud database product, which is their fully managed service. And they noted that a record number of new customers were building AI applications on its platform.
There's that AI validation again.
Exactly. It directly validated its strategic positioning in the burgeoning AI ecosystem, underscoring its role in providing the foundational data infrastructure for the AI revolution. It makes it a clear winner in the AI narrative, similar perhaps to NVIDIA's hardware dominance, but on the software side.
Okay, huge win for MongoDB. What about Kohl's? You mentioned their operational success.
Right. Then there was Kohl's, KSS. The department store chain saw its shares surge by nearly 24% in a powerful relief rally.
Also a massive move, especially for a retailer.
It really is. This move was triggered by a second quarter report that revealed a substantial profit beat, defying expectations in a challenging retail environment. Kohl's reported an adjusted EPS of 56 cents. That was almost double the Wall Street consensus of approximately 31 cents.
Double estimates, nice.
Yeah. The company also raised its full-year adjusted EPS guidance to a range of 50 cents to $80, well ahead of prior forecasts. And this impressive bottom-line performance was achieved despite a 5.1% year-over-year decline in revenue.
So sales were down, but profits were way up.
Precisely. It indicates that the company's turnaround efforts focused heavily on disciplined cost-cutting, efficient inventory reduction, and gross margin expansion through more strategic pricing are proving highly effective. It's a testament to strong operational management and a successful restructuring of the business model, even when top-line growth is hard to come by in a fiercely competitive retail landscape.
Okay, so good news stories there. But there were also some big losers, right? Let's talk about the anatomy of a decline. You mentioned SUPX, NACA, and Open.
Yes. Now, for the other side of the coin, the anatomy of a decline. Let's unpack the sell-offs in SUPX, NACA, and Open. Super X AI technology, SUPX shares plummeted by more than 33%, making it one of the day's biggest losers.
Ouch. What happened there? Bad news.
What was particularly telling here is that this sharp decline was not driven by any new negative company-specific news or a disappointing earnings report.
Really? So what caused it?
Instead, it appears to be a classic case of a parabolic rally collapsing under its own weight. The stock had experienced a meteoric rise of over 1,100% in the past year.
1,100%. Okay, yeah, that's parabolic.
Definitely. And technical indicators like the Relative Strength Index,
Hmm.
RSI, climbing significantly above its 70-point threshold, suggested the stock was in severely overbought territory. For the informed investor, this signals that the price had risen too rapidly and was likely due for a profit-taking correction. The underlying momentum becomes unsustainable, and valuation disconnects from fundamentals.
So just pure profit-taking on a stock that got way ahead of itself.
Pretty much. This sell-off represents a stark example of profit-taking in a high-momentum name where valuation had become completely detached from underlying fundamentals. It proves that even in the AI boom, gravity still exists for overextended stocks.
Gravity always wins eventually. Okay, what about NACA? Kindly MD, down over 20%.
Right. Kindly MD, NA, which is a healthcare services and Bitcoin investment company, kind of an unusual mix,
Yeah.
saw its stock plunge by over 20%. The sell-off was a direct response to the company's announcement that it had filed for a massive $5 billion into the market, ATM equity offering program.
$5 billion. That sounds like a lot. What's an ATM offering?
It is a lot, especially relative to NACA's market cap. An ATM offering allows a company to sell new shares directly into the open market at prevailing prices over a period. It's flexible for the company.
But bad for existing shareholders.
Often, yes. An offering of this magnitude creates significant investor concern about the potential for massive shareholder dilution. Issuing new shares reduces the ownership stake and earnings power of existing shares, basically shrinking their piece of the pie. This fear completely overshadowed any positive sentiment from the company's recent merger or its strategy to build a Bitcoin treasury. It demonstrates that even a potentially exciting long-term strategy can be negated by immediate concerns about the fundamental value of one's ownership stake. Dilution risk is a powerful negative catalyst.
Okay, dilution fears sank NACA. And finally, Open Door Technologies Open, down over 13% and very actively traded.
Yes, Open Door Technologies, Open, the real estate technology firm, was one of the most actively traded stocks of the day, falling more than 13%. The decline was fueled by persistent investor uncertainty surrounding a potential reverse stock split.
Reverse split? Why is that bad?
Well, the company had previously postponed a special stockholder meeting, rescheduled for August 27th, to vote on the matter. A reverse stock split is a corporate action often perceived as a measure of last resort.
Why?
It's typically done to artificially inflate a stock's per-share price, usually to maintain its listing on a major exchange if the price falls too low, like below $1. It reduces the number of outstanding shares but increases the price per share proportionally, so the total market cap doesn't change.
But the market sees it as a sign of weakness.
Frequently, yes. It's often viewed as a sign of underlying business distress or lack of confidence in the company's future by management. This lingering uncertainty weighed heavily on Open's stock, causing it to surrender a portion of its recent gains. And those gains had largely been attributed more to speculative meme stock trading activity rather than fundamental improvements in its iBuying business model.
Ah, so meme stock volatility plus reverse split fears. Got it.
Exactly. It highlights how quickly sentiment can shift when a company signals potential trouble, especially for highly speculative names.
So after these dramatic stories of growth, turnaround, and collapse, what's the actionable takeaway here for you, the listener? This isn't merely a lesson in market segmentation. It's a stark reminder that even on days of seemingly placid index movements, the underlying currents are driven by granular, company-specific narratives. This underscores the increasing value of active, informed selection over passive indexing. It demands a deeper dive into fundamental catalysts and idiosyncratic risks. For the astute investor, understanding these individual sagas is crucial, as they often foreshadow broader shifts or highlight overlooked opportunities.
Well said. The details really matter in this kind of market.
Okay. Beyond the drama and excitement in equities, what were other asset classes telling us about the broader trends in economic expectations, inflation, and overall risk appetite on August 27th? It's like looking at a full dashboard of gauges, right? Gives us a more complete and interconnected picture of the global financial system.
Absolutely. Analysis of other asset classes provides crucial context for the day's equity market performance, really completing our picture. These markets often react to different nuances and can offer early warnings or confirmations of trends that might not be immediately apparent in stock movements alone. They serve as vital complementary indicators.
So let's start with the bond market. What were treasuries doing?
Okay, starting with treasuries and the yield curve. The U.S. Treasury market signaled growing conviction in a forthcoming monetary policy shift that Fed cut we talked about. The yield on the benchmark 10-year Treasury note declined for the second consecutive day, settling at 4.238%.
Yields down, prices up, so demand for bonds.
Correct. This downward move in yields, which move inversely to bond prices, is directly linked to the market's strong pricing of that near-certain Fed rate cut in September. When bond yields fall, it suggests investors expect lower future interest rates, making current bonds more attractive. Or it can reflect a flight to safety during uncertain times. And interestingly, the political turmoil surrounding the Federal Reserve's independence, which we discussed,
Right, the potential politicization.
that may also be contributing to a modest flight to safety bid for government bonds, further pressuring yields lower. In times of heightened uncertainty, U.S. government bonds are often seen as the ultimate safe haven, regardless of other factors, drawing capital from riskier assets.
So maybe a combination of rate cut hopes and a little bit of safety seeking.
That seems likely. A convergence of those two factors created strong demand for treasuries.
Okay. What about commodities? What was happening with oil, gold, agriculture?
Moving to the commodities complex, we saw a mixed bag, reflecting various supply and demand dynamics. In energy, West Texas Intermediate, WTI, crude oil futures gained ground. The front-month contract rose over 1% to trade around $64.15 per barrel, eventually closing at $63.83 per barrel, up 0.92%.
Oil up. Why was that?
This price increase was primarily supported by a mid-morning report from the Energy Information Administration, EIA, showing another draw in U.S. crude oil inventories. That marked the third consecutive weekly decline.
Okay, so inventories falling suggests decent demand or tight supply.
Exactly. This tightening supply picture, even amidst some global growth concerns, suggests that the market remains sensitive to any perceived shortfall, especially with OPEC plus production cuts still largely in effect and global demand projections, particularly from Asia, showing some resilience. It indicates the supply-demand balance in oil remains tighter than maybe some might assume.
Got it. What about gold? You mentioned it benefits from rate cut expectations and uncertainty.
Right. In precious metals, gold prices consolidated after a strong recent run. Spot prices retreated slightly to around $3,380 per troy ounce after briefly testing the psychologically important $300 to $400 level earlier in the week.
So pausing a bit after a run-up.
Yeah, take a breather. But the metal's recent strength has been fueled by that combination of factors. Expectations of a more dovish Fed, which typically weakens the dollar and makes gold, priced in dollars, more attractive to international buyers. And furthermore, its traditional appeal as a safe haven asset amid rising concerns over the central bank's independence, that theme we explored, has added to its allure. Gold often shines when there's perceived instability in traditional financial systems, or when inflation expectations tick up.
Okay. And agriculture. You mentioned headwinds there.
Yes, as for agriculture, markets faced headwinds from both weather and geopolitics. Wheat and corn futures were pressured by ongoing U.S. harvest activity. Initial yield reports were coming in pretty robust, indicating ample supply.
Good harvest means lower prices.
Typically, yes. This has kept prices subdued, challenging profit margins for many American farmers already grappling with higher input costs and uncertain demand. Meanwhile, U.S. soybean farmers continue to grapple with the prolonged absence of China, their largest customer, from the export market.
The trade dispute impact.
A direct and painful consequence, yeah. The latest data showed a 28% year-over-year drop in soybean sales to China. This persistent trade tension is weighing heavily on prices, pushing some local farmers towards unsustainable operating conditions. It highlights how global politics can have a very direct, tangible impact on local economies and commodity supply chains.
Definitely. Okay, lastly, what about currencies, the US dollar specifically?
Finally, let's look at currency currents. The US dollar index, DXY, which measures the greenback against a basket of 6 major currencies, was little changed. It hovered around the 98.20 mark, closing at 98.218, down just a marginal 0.01%.
Basically flat. Why was that, given all the cross currents?
Well, the dire stability reflects a fascinating tug of war between competing forces. On one hand, the high probability of a near-term Fed rate cut is typically a headwind for the currency. Lower interest rates can make the dollar less attractive to international investors seeking yield, potentially leading to capital outflows.
Right, lower rates, weaker currency usually.
Usually. But on the other hand, its status as the world's primary reserve currency provides a crucial safe haven bid during times of geopolitical or domestic political uncertainty, like the current situation involving the Federal Reserve's independence.
Ah, so the rate cut pressure pushing it down, but the uncertainty pulling it up?
Exactly. These opposing forces largely canceled each other out on Wednesday, leaving the dollar largely flat. But it masks a deep underlying tension that could resolve powerfully in either direction, depending on future events.
What's particularly illuminating here, listening to all this, is how these seemingly disparate markets, bonds, oil, gold, grains, currencies, are all reflecting the same core themes we've been discussing today. The strong anticipation of a Fed pivot towards easing, the emergence of systemic political risks to institutional credibility, and significant shifts in global supply and demand. It truly underscores how interconnected our financial world is, affecting everything from your gas prices to the long-term value of your investments. It demonstrates that no single market operates in a vacuum, but rather as part of a complex, responsive global ecosystem.
Absolutely, it's all tied together.
So what does this all mean after our deep dive today? As we look back at August 27th, the market's quiet ascent to a new record was indeed deceptive, wasn't it? It marked a deep underlying tension and a significant concentration of event risk squarely on the shoulders of one company, NVIDIA.
Exactly. While the positive earnings surprises from MongoDB and Kohl's were encouraging signs of corporate health in specific sectors, offering some much-needed positive individual stories, they were ultimately overshadowed by the market-wide referendum that NVIDIA's earnings represent. Looking immediately ahead, the path for the market will be dictated largely by the after-hours reaction to NVIDIA's results and management commentary. A strong report could powerfully validate the AI investment thesis, propelling the technology sector and the broader market higher, continuing the momentum we've seen. Or a disappointment could trigger a significant repricing of risk, particularly in the highly valued growth segments of the market, which have relied so heavily on the AI narrative. That could potentially lead to a significant unwinding of positions.
Okay, so all eyes were on NVIDIA after the bell. What comes next, after that immediate reaction?
Well, beyond this immediate catalyst, investor focus will very quickly shift to the next major economic data release. The Personal Consumption Expenditures, or PCE, price index.
The Fed's preferred inflation gauge.
That's the one. It's favored for its broader scope, its ability to capture consumer spending shifts, and its typically less volatile nature compared to the CPI. It makes it a more consistent gauge of underlying price pressures. This report will be critical in either confirming the Fed's recent dovish pivot, which the market is so heavily pricing in,
Right, that 87% chance of a cut.
or potentially forcing a hawkish reassessment if inflation signals come in hotter than expected. And this begs the critical question. How much flexibility does the Fed truly have to ease if inflation proves stickier than anticipated? And what would that mean for market expectations?
Yeah, that's a big question.
And finally, the unresolved issue of the Federal Reserve's political independence has now emerged as a persistent, low probability, but potentially high-impact tail risk.
That slow burn risk.
Exactly. Any further escalation of political pressure could undermine investor confidence in U.S. institutions, with far-reaching consequences for capital flows and market stability globally. The market currently stands at a critical juncture where the powerful long-term narrative of AI-driven growth is being tested against a backdrop of weakening consumer data and rising political risk. It's a complex interplay of forces that demands constant vigilance from investors.
So after today's deep dive into these intertwined forces of technology, politics, and economics, it really makes you wonder, in a market so dependent on a few key narratives and specific events, how much of what we see is fundamental reality and how much is simply collective belief and anticipation? perhaps the most critical insight from August 27th isn't just what did happen, but what the market collectively chose to ignore, or at least defer, while fixated on NVIDIA. That very act of deferral, of pushing systemic risks like Fed independence to the background for a single event, might be the true signal of an increasingly fragile and narrative-driven financial system that you need to be aware of. What will truly steer the ship when these biggest tides shift, and how will you navigate those increasingly complex waters? Keep learning, keep questioning, and thank you for joining us for this deep dive.